Okay, let's be honest. It's exciting to see money come in every single month from your investments. It's the ultimate passive income win. Nice. So in this video, let's talk about 5 dividend-paying ETFs that pay you dividends every single month. Now, if you're a beginner investor, what dividends are? They are payments made by a corporation to the shareholders, that's you and I, that are paying those dividends from their profits. They pass along those profits in the form of dividends or extra shares. Now, an ETF, otherwise known as an exchange-traded fund, is a collection of different companies, a collection of different stocks. And the nice thing about that is when you look into an ETF, you have automatic diversity. You're not just putting all your eggs into one basket by investing all your money with one particular company. By investing in the ETF, you get a collection of maybe 50, 100, even 3,000 different companies. So 5 ETFs for 5 monthly paying dividends. Now, a lot of times dividends are paid every quarter, twice a year, sometimes even once a year. But it's kind of cool to see payments every single month, and that's the point of today's video. Now, I'm gonna give you 5 different type of options. We're not just gonna look at 5 random monthly dividend ETFs. That's kind of boring. I wanna look at different avenues, different angles that you can look at. Now, of course, none of this is financial advice. You gotta do your own research, but it gives you an understanding of different things that are out there, different flavors of the stock market that you can look into to make your best decision for those monthly paychecks. Some of the different opportunities we're going to look at are ETFs focused on the S&P 500, that is the top 500 companies in America. We're going to look at ETFs that focus on international exposure, banks, covered call option strategies, and some real estate exposure. Dividend paying ETF number 1. And that's the one focused on the S&P 500. As I mentioned earlier, 500 top companies in America, and that is ticker symbol SPHD. So while this one does track the S&P 500, there are a couple of things to keep in mind. It does focus on low volatility. So this is about generating you income and dividends, and the S&P 500 has a mix of dividend-paying companies as well as growth companies that are focused on growing in the long term. Now, because it is an ETF and there is a fund manager, you do have to pay an expense ratio. That expense ratio for this particular fund is 0.30%. That means for every $1,000 that you have invested, $3 will be taken out for the yearly expense ratio. But that comes backed up with a very nice dividend yield of 3.77%. Now, before we get to the monthly part of SPHD, let's take a look at that low volatility. Now, as you can see here on Seeking Alpha, one of my favorite investing research platforms to look at, you can see that the returns over the last couple years are a little bit lower than the S&P 500. Even though it tracks S&P 500, remember, it's focused on that low volatility. So in the last 3 years, you can see that 7.81% trailing significantly below the S&P 500 return. So as we can see here, the last payment, 14 cents per every share with an ex-dividend date of 123. Now we can see it paid a decently consistent dividend history over the last 5 years, right around that 14 cents as we're looking every single month. It did dip down here in 2021 to 12 cents, but it has been fairly consistent with that 14-cent return every month. If you like the S&P 500, if you like monthly dividends, this is one that you can consider doing a little bit more research on. Let's move on to number 2. Now, number 2, we're going to take a step into the international market. Have a look at CID. This is Victory Shares International High Dividend Volatility ETF. Right now, it does have a higher expense ratio at 0.45%, which means for every $1,000 you have invested, it'll be $4.50 in the expense ratio. The dividend yield comes in at a nice 5.24%. So it splits at $17 million in assets across several different international categories, investments in the Eurozone, Canada, Asia developed, Japan, and in the United Kingdom. So you get that immediate cross-international exposure from this one particular ETF. Now, there's something that you need to keep in mind. There's a little bit of a warning here, and that is its total price return. And because it is a focused international fund, it's not going to perform as well as the S&P 500. So if you look over here on Seeking Alpha, you can see that price return. 3 years, minus 1.73, and 5 years, minus 14.64%. Now, the total return, including the dividends, is where it makes up for that at 8.73% in the last 5 years. Of course, if you compare that to the American companies of the S&P 500, that is down significantly compared to the 44.37%. So here are the top 10 holdings across the world. I do know SoftBank Corporation. I don't know the rest of them, but I'd be interested. Do you guys know any of these companies? Are you familiar with any of these international companies? If so, drop a comment down below. Now, the dividend history on this one, unlike the SPHD fund, is a little bit squirrely. As you can see, it hasn't had as much of a consistent dividend payout, but it does go high and then it does go low. For example, if we look over here, in June of 2022, paid down a 44-cent per share dividend, followed up by 29 cents and then down to 7 cents. But let's say you want to look at some companies that are a little bit more just long-standing, healthy, well-diversified companies. Well, let's take a look then at DHS. This is the Wisdom Tree US High Dividend Fund. There's going to be a lot of companies that I'm sure you're familiar with in this particular ETF. Now this has an expense ratio of 0.38%, costing you $3.80 for every $1,000 you have invested into this particular fund, and the dividend yield at 3.33%. Currently going for $88.14 per share, so a little bit more expensive than the other two that we just looked at. Now, if we look over here on the dividend yield tab, this is very interesting to look at. Now, right now, like we said, it was 3.33%, but look at it back here in 2020, it's shooting up. You might be wondering, why is that for, everything else that was crashing? Well, remember, this one holds those long-standing commodities. There's companies that kind of thrive when people need them the most. So because of that, a lot of profits were flowing into the companies that tend to provide commodities, which is where a lot of the focus back in 2020 went when everybody was scrambling during the pandemic. So as a result, their profits went up and that yield did go up to its highest rate of about 6.93%. Now, having a look at their holdings, and let me know if you're familiar with any of these companies: ExxonMobil, Chevron, Philip Morris, Pfizer, Cisco Systems, AT&T, and IBM. Very long-standing, consistent companies. Now, if you're like, let's take a break from all these companies, S&P 500, we got the international, we got the strong standing financial companies, why don't we talk a little bit about something interesting? And that is options. See, options give either the buyer or the seller the right to either sell or buy 100 shares of any particular company as a result of a certain price that's reached at a strike date. But you don't have to worry about all that because there are companies that actually give you premiums based on options writing strategies. Now, on this channel before, we've talked about the fund QYLD, and what that does is it basically writes covered calls against the NASDAQ 100 index. But in this video, I'm not just gonna repeat another version of QYLD, we're gonna look at the sister of QYLD, and that is the fund XYLD. Currently going for $40 per share. What makes this one a little bit different is that it actually writes covered calls against the S&P 500. So because it's writing against the S&P 500, you have an opportunity to get a little bit more potential growth, but a little bit more potential revenue income. So you can see that yield at 12.82%. And as a result of that strategy, of course, this is going to be one of the highest dividend yields on today's list for monthly paying dividend ETFs with an expense ratio of 0.60%. That means $6 for every $1,000 you have invested. Now, because its focus is on providing that monthly dividend paying income, it's not going to be as focused on growth. As a result, as we can see here, the price return is a little bit lower both in the 3-year and the 5-year compared to the S&P 500, but the total return is a positive in the last 5 years, sitting at 19.94%. But let's have a look at this awesome dividend, shall we? 41 cents per every share, thanks to that high 12% dividend yield. And of course, that was last paid out on January 31st in this particular example. But every single month, that one's pretty cool, right? You buy $40 worth of one share and you give yourself a 41-cent raise. If we look over here at the dividend history of this particular fund, you can see it's been decently consistent, paying anywhere here from 34 cents, 37 cents, up to 48 or 50 cents per share. Now remember, this one is a little bit of a different one compared to the other ones that we're looking at. So make sure you do a little bit more research on this. There is some interesting things when it comes down to taxes, as well as how they actually distribute that 12% dividend every single month, even when they don't make money on covered call option strategies. So if you want to learn more about that, you can look at the QYLD video. I'll link down below in the description. It's the same thing, only you got to think about XYLD instead of QYLD, but the fundamentals are all the same. Now, we've talked about all these different companies. We've talked about this other unique. Let's talk about number 5, the last one on the list, focuses on banks and financial groups, and that is PGX, the Invesco Preferred Portfolio ETF. Now, they focus on preferred companies, and they do focus a little bit more on the financial end with holdings such as Citigroup, Wells Fargo, and Bank of America. This is one of the cheaper funds on the list at only $12.62 per share as of the recording of this video, with a dividend yield of 5.59%. Expense ratio is 0.50%, that's $5 for every $1,000 invested. The last announced dividend, 6 cents per share in this example, paid out on 1/27. And this one only pays 6 cents per share at a dividend yield of 5.59%. Well, if you're new, remember, you get what you pay for. The DHS fund costs a lot more money per share. This one only costs $12.62 per share as of the recording of this video, so that 5.59% will not yield as much as a result, which is why it's only 6 cents per share per month. So those are the top 5 dividend paying ETFs, and if you want to see more, because there's a lot more monthly paying ETFs, make sure you subscribe for more videos coming here to the channel. But let's talk about something fun. Now, of course, to get to something fun, we got to talk about something that's not so fun, and that is the fact that a lot of times people often will focus on buying things that they don't necessarily necessarily need. And I'm guilty of that myself. A couple of years ago, I decided to buy a brand new car that I didn't really need. And I thought, oh, it's gonna look cool and people are gonna think I'm cool. And that was just a stupid mistake because it cost me $300 a month to do that. And so I got rid of that. I'm now debt free. But think about it this way. The average car payment right now in America is anywhere from $500 to $700 a month. Let's say you still get a good car, but you don't get a very expensive car, and you can cut back some of that monthly payment. And instead what you do is you invest into a dividend paying ETF. Let's take Wisdom Tree, for example, that we shared earlier in the video. So right now, as of the recording of this video, it's going for $88.06 per share. But what you're gonna do is you're gonna invest every single month. You're gonna invest $100 a month into DHS every month for the next, let's say, 10 years. As you buy new shares, you can basically just get that monthly dividend, cash it out, and run right to the bank with it, or go out and have a beer with it, or whatever you'd like to do with that. Or you can do something called DRIP. That stands for Dividend Reinvestment Program. And what that will do is your brokerage will take the dividends, and instead of passing those dividends on to you, they're gonna reinvest it back into the share, back into the ETF, and give you even more shares. So your dividends make money on your prior dividends, and it just keeps snowballing up. And all of a sudden you make more money than you did if you would have taken that money and went and had a beer with it. So let's do a little bit of a visualization to see what happens over the next 10 years. Now, past performance does not equal future performance, but let's say from 2011 to 2022, you invest $100, and you're gonna do that every single month for the next 10 years. And you are gonna reinvest the dividends back into this fund. So if we take DHS, look at what happens. Over the next 10 years, you grow to $29,000, and that's only $100 a month. So if you wanna say, hey, a couple things I could do here. I could ignore this and just say, it doesn't seem like a lot of money to me, inflation's high and everything sucks. Well, what happens 10 years from now between the person that actually does this and gets up to that 29,000 versus the person that doesn't do it, and what's their plan otherwise? How are they gonna do it? And don't give me some scammy thing. I mean, let's be honest with ourselves here. If you just stick with a consistent plan, you could really grow this. But let's scroll down a little bit further because there's something really cool to look at down here at the bottom, and that is your portfolio income. All dividends and distributions were reinvested, but take a look here in the last 10 years. Over the next 10 years, if you would have started in 2011, look how much money you're making every single year just in dividend payouts alone, $956. So you're almost at a point that you're making $100 a month in dividends just off of this very simple $100 a month. And that isn't, to me, a whole lot to really ask for. The goal would be you invest a lot more and you invest in many different diversified companies, but you let that snowball grow into something really, really cool. How are some other ways that you might be able to grow to $1,000 a month in dividends? Check out this video next, and we'll see you over there.